Imagine waking up one morning to discover that nearly $41 trillion, double the size of the U.S. economy, has vanished from global financial markets overnight. Sounds like a doomsday movie scenario? But this is a real warning from Bank of America, and it's shaking Wall Street to its core. Is the global economy teetering on the edge of an unprecedented financial crisis? The big question is, are Donald Trump's policies pushing the global economy toward an irreversible financial catastrophe? Let's explore the dangerous factors that could make this $41 trillion disappear in the blink of an eye. In the past, the U.S. dollar and Treasury bonds were considered safe haven assets during times of uncertainty, but now confidence in the dollar is seriously eroding. U.S. public debt has surpassed $35 trillion, over 100% of national GDP, raising doubts about America's long-term financial stability. This debt level not only widens fiscal gaps but also undermines the government's ability to repay, shaking investor trust. On top of that, the Federal Reserve's aggressive interest rate hikes to combat high inflation are making borrowing increasingly expensive. This reduces the appeal of Treasury bonds, prompting foreign investors to pull out, weakening the dollar and triggering global financial instability. More and more countries are rejecting the use of USD in international trade, weakening America's financial power. BRICS nations, including China and Russia, have ditched the dollar in favor of the yuan and other local currencies. China is even developing a digital yuan to replace the USD in cross-border transactions. If this continues, the US dollar could lose its status as the world's reserve currency, severely eroding global trust. The result? A rapid decline in the dollar's value, triggering chaos in global markets, especially for dollar-denominated assets. Global corporate debt has exceeded $72 trillion, accounting for 92% of global GDP. Large companies have over-leveraged in recent years and now face high interest rates, making repayment incredibly difficult. If interest rates continue to rise, thousands of firms may default, igniting a debt crisis and shaking financial markets worldwide. Mass defaults could create a domino effect, leading to the collapse of global investment funds and banks. A highly dangerous yet overlooked factor is the existence of the shadow banking system. These investment funds and unregulated financial entities now hold $63 trillion in assets, posing massive systemic risks. If these funds face liquidity issues, it could plunge the financial system into a severe crisis. With U.S. debt exceeding $35 trillion, over 100% of GDP, America faces its highest debt burden in history. This not only reflects financial strain but also erodes confidence in the government's fiscal stability. As the Fed continues raising rates to tame inflation, borrowing becomes costlier, undermining economic recovery. International investors are pulling out of U.S. bonds, dragging down the dollar's value. As the dollar depreciates, it could spark a global liquidity crisis as capital flees U.S. assets. The falling dollar also makes USD-denominated national and corporate debt much more expensive. If international investors pull funds from U.S. bonds and major stocks, we could witness a global stock market crash. The dumping of U.S. assets would drag down major indices like the Dow Jones and S&P 500 and directly hit pension and investment funds. Pension funds currently invest heavily in U.S. Treasury bonds and stocks, making up 60 to 70% of their total assets. A market collapse could wipe out billions of dollars from these funds. Since the Fed raised rates from near 0% to 5 to 6% between 2022 and 2023, borrowing costs have skyrocketed, especially for consumer and mortgage loans. Higher interest rates increase debt burdens, causing financial stress for families and businesses. Meanwhile, inflation in many countries has surged to 5 to 9%, pushing living costs through the roof. Food and energy prices keep climbing, especially with oil prices remaining high. Inflation is reducing purchasing power and straining household budgets. The rise of de-dollarization is weakening the dollar. Countries, especially BRICS members, are shifting to local currencies or China's yuan in global trade. This could strip the dollar of its reserve currency role, leading to further depreciation. Nations are also turning to assets like gold, crypto, or national digital currencies like China's digital yuan. As demand for USD falls, its value may plummet, destabilizing asset values worldwide, especially for those holding USD-denominated wealth. With U.S. debt surpassing $34 trillion, over 100% of GDP, the burden is historic and growing. This rapid debt growth threatens the government's ability to repay. While high debt-to-GDP ratios may be tolerable for developed nations, elevated public debt means higher borrowing costs and lower credit ratings, raising financial risks. Moreover, the Fed's interest rate hikes, from about 0% to 5 to 6% between 2022 and 2023, are making borrowing more expensive for both the government and businesses. Without cutting inefficient spending and investing in long-term infrastructure, the U.S. risks financial instability and loss of investor confidence. IMF experts warn that without fiscal reform, interest payments could consume up to 20% of the national budget in coming years, leading to higher inflation and slower growth. Investing in renewable energy, sustainable agriculture, and green infrastructure reduces risk while promoting long-term growth amid global volatility. Clean energy investments exceeded $500 billion in 2023, Bloomberg NEF, and are expected to grow even more. With traditional energy systems strained by climate change, renewables are leading the green economy, mitigating environmental risks and creating millions of new jobs. To protect assets during a financial crisis and market turbulence, portfolio diversification is essential. Allocating assets into gold, non-urban real estate, and low-debt government bonds can help hedge against extreme volatility. Gold, seen as a safe haven, has surged 40% from 2020 to 2025, as the dollar weakened and investors sought stable returns. Meanwhile, investing in non-urban real estate in fast-growing areas like Texas and Florida shows strong performance. These states have seen population growth of up to 3% per year over the past decade, presenting attractive investment opportunities. Additionally, low-debt sovereign bonds, like those from Singapore and Norway, offer effective asset protection. Singapore's public debt is only about 110% of GDP, far lower than most developed nations, making its government bonds a safe choice during financial turmoil. Another critical solution is tax policy reform to generate new sources of national revenue without increasing the burden on businesses and citizens. The government needs to improve the tax system to ensure fairness and encourage investment in strategic sectors such as high technology, renewable energy, and green infrastructure. This would not only promote economic growth, but also create job opportunities in innovative and sustainable industries. Tax reform can also help reduce public debt by creating stable revenue streams from the taxation of tech companies, especially in the context of rapid growth in the digital economy and digital transformation. In addition, implementing a carbon tax on polluting industries would generate significant revenue for the national budget while incentivizing businesses to reduce emissions and transition to renewable energy. In 2025, America's retail and food industries are facing a full-blown crisis. From mass store closures to skyrocketing prices, major chains like Walmart, Kroger, Target, Dollar Tree, and Amazon Fresh are being hit hard by the Trump administration's new tariff policies. Walmart, the largest retail chain in the U.S., is facing major difficulties in keeping operations running. The company announced the closure of at least 11 stores in early 2025 and is expected to shut down more locations later this year. According to Walmart CFO John Rainey, a 10% tariff on avocados imported from Costa Rica and a 15% tariff on bananas from Mexico will drive up costs, which will then impact the retail prices of these items. Banana prices at Walmart could rise by about $0.3 per bunch, which is a 20% increase for this item. A 10% tariff on avocados pushes the price from $2.5 each to $2.75, an increase of 10%. Even though the price increase for each individual item is not huge, when added up across the entire shopping cart, an average American household could end up paying $30 to $50 more per month for essential groceries and household products. This could raise total annual spending from $3,600 to $3,802.2, an increase of $202.2. Assume a low-income household, earning an average of $30,000 per year. They spend the majority of their income on food and household items, about 40% of their income, or $12,000 annually. If the prices of essential goods rise by 10 to 15%, this family will have to spend an additional $1,200 to $1,800 per year on food and household products. This means the added cost could take up 3% to 4% of their annual income, increasing financial pressure and potentially forcing them to cut back on other expenses like healthcare or tuition. Dollar Tree and Family Dollar, two well-known U.S. chains known for offering low-cost products, especially for low-income families, are also being heavily impacted by tariffs. In fiscal year 2024, Dollar Tree closed 695 stores and is planning to shut down another 370 in the near future. This is part of a restructuring strategy aimed at offsetting revenue losses and coping with the effects of tariffs. Tariff hikes of 20–30% on imported goods from China and other countries have significantly affected both Dollar Tree and Family Dollar. These chains heavily rely on importing low-cost products from international markets, especially China. The items they provide to consumers include processed foods, household supplies, and affordable everyday goods. For example, if you typically spend $300 a month at these stores, rising prices could push your monthly bill up to around $307 to $310.5. That might not seem like much to some, but for low-income households, this added cost can become a real financial burden over time. Dollar Tree's $1 model has long been a unique business strategy, selling everything at a fixed price of just $1. It specifically targets low-income shoppers, particularly in rural and urban areas, where people are looking for essential goods at affordable prices. That's been a key factor in Dollar Tree's lasting appeal, especially during tough economic times. However, this model is now struggling to survive under the weight of tariffs. As import costs rise from countries like China and Mexico, the store can no longer maintain the $1 price point, undermining the very foundation of its business model. Once prices creep above $1, customers, especially those with tight budgets, will start looking elsewhere for better deals. These are the core customers Dollar Tree depends on. As a result, customer loyalty is dropping and shoppers are moving to stores not hit as hard by tariffs. That means fewer purchases and shrinking revenue, ultimately weakening the chain's overall performance. Kroger, the second largest retail chain in the U.S., has announced plans to close 60 stores over the next 18 months, representing about 5% of its total locations. Kroger relies heavily on sales of essential items like rice, cereals, and canned goods, staples for many households, especially low-income families. When 25% tariffs push up the prices of these goods, the cost of ingredients rises, driving up the retail prices of items such as rice and canned foods. Financial experts predict that Kroger could face losses of up to $100 million in the next quarter due to the added cost from tariffs. Kroger has started scaling back promotions like direct discounts and product-specific coupons. Instead of offering weekly deals, the company is shifting toward a discount store model focused on cutting operational costs rather than providing attractive promotions. This change makes many loyal customers feel they are losing value when shopping at Kroger, leading to fewer store visits. This not only reduces Kroger's appeal, but also weakens its ability to retain customers long-term, causing damage to both revenue and brand reputation. Target, one of the largest retail chains in the U.S., reported that its first quarter revenue fell 3.8% in May 2025, resulting in nearly $10 billion in lost market value. A 30% tariff on imported goods from China has pushed Target's product prices up by 10–15%, especially for fresh foods, household goods, and electronics. To reduce the impact of tariffs, Target has cut the size of certain products, including fresh vegetables, bread, and other perishable items, leaving customers unhappy with the changes. This has the potential to erode customer loyalty, as shoppers feel they're getting less value for familiar products. Frustrated customers may turn to competitors that continue to offer stable product sizes and quality, which could reduce Target's revenue and long-term customer appeal. The drop in customer loyalty has severely affected Target's revenue and profit. Since the company cannot easily replace fresh products with lower-cost alternatives, its first quarter revenue fell 3.8% in May 2025, wiping out nearly $10 billion in market value. Fresh food sales were hit hardest, with revenue from produce and meat down 5–7% compared to the same period last year. These changes have significantly cut into Target's profits, creating major financial pressure to keep operations running. Amazon Fresh, Amazon's online grocery retail service, has also been hit by tariffs. Even though Amazon has invested heavily in its online sales model, shipping and warehousing costs have risen sharply due to tariffs. A 25% tariff has significantly increased Amazon Fresh's operating costs, especially for fresh items like vegetables, fruits, and meat. Several Amazon Fresh stores were forced to close in 2025, particularly in major cities, as costs could no longer be balanced with revenue. In one example, warehousing and shipping expenses rose by about 15–20% due to tariffs and higher fuel prices. This made it impossible for urban Amazon Fresh locations, where rent is already expensive, to cover their operational costs through sales. Reports show that stores in Los Angeles and New York had to close because revenue couldn't keep up with the high costs of maintaining storage and shipping operations. Low-income households, which already spend most of their budgets on food and essential products, are the group hit hardest by these new tariffs. These families will have to spend a larger share of their income on food, forcing them to cut back on other necessities like healthcare or education. Projections show that food expenses could account for 15–20% of total income for low-income households, creating significant financial pressure. To save money, consumers may reduce their shopping or switch to lower-quality products, which lowers their standard of living and can harm health, especially when fresh, nutritious food becomes harder to afford. As prices for essentials rise, consumers will look for cheaper alternatives. For example, fresh vegetable prices have risen 15–20%, pushing many families toward processed or frozen foods, even though they are less nutritious. A Yale University study found that about 40% of consumers changed their shopping habits in 2025, opting for cheaper products that don't fully meet nutritional needs. With higher living costs, consumers are reducing spending on non-essential items like entertainment and travel. For instance, travel spending dropped 12% in 2025, while the entertainment sector saw a 10% decline in revenue. These cutbacks not only lower quality of life but also negatively impact the broader economy by reducing overall demand, hurting service, tourism, and consumer industries. From Walmart and Dollar Tree to Kroger and Target, America's retail giants are facing a crisis triggered by the new tariffs. Prices are climbing, stores are closing, and long-standing business models are being disrupted, pushing consumers, especially low-income families, into harder times than ever before. Whether Washington will have the courage to change its policies to rescue the retail industry and ease the burden on everyday Americans remains an open question. When Canada started boycotting American products, it wasn't because of mass protests or loud slogans. It started with a single political decision. Trump raised tariffs, and the cost of that decision hasn't just been tense negotiations. It's triggered a deep shift in Canadian consumer behavior, with billions of dollars in cross-border trade now at risk. In February 2025, President Donald Trump slapped a 25% tariff on nearly all Canadian imports, except energy, which faced a 10% rate. Canada responded by imposing matching tariffs on $30 billion worth of U.S. goods, with an additional $125 billion in tariffs announced for the coming weeks. Canadian consumers did not take this sitting down. They reacted fast and forcefully. As U.S. tariffs disrupted trade, Canadian consumers responded in kind, not just with words, but with action. Shopping habits transformed overnight. Every purchase became a political decision, a rejection of Washington's trade policy. A February 2025 Angus Reid survey found that 78% of Canadians said they now prioritize Canadian-made goods over American ones. That's a clear signal of a fundamental shift in consumer mindset. Even more striking, 59% said they would avoid American products altogether in the near future. And a whopping 98% reported actively seeking out Made in Canada labels while shopping. This isn't symbolic, it's systemic. To help shoppers steer clear of U.S.-made goods, a wave of mobile apps launched. MapleScan, Buy Canadian, Is This Canadian, and O Scanada. These apps allow users to quickly scan product barcodes and identify the country of origin. The Buy Canadian app alone has attracted over 1.2 million users, turning what began as a protest into a nationwide consumer movement. Canadians are no longer passive buyers. They're actively aligning their purchases with their values. By May 2025, the number of Canadians crossing the border into the U.S. had dropped by a staggering 38.1% compared to the previous year. The U.S. used to be a top vacation spot for Canadians. Now, with rising political tensions and tariffs, many are choosing alternative destinations, like Mexico and Europe. It's not just cross-border traffic by car. AIR travel from Canada to the U.S. is also down 24.2% year-over-year. Major carriers like Air Canada and WestJet have confirmed a sharp decline in U.S.-bound flights and passengers. Airports like Toronto Pearson and Vancouver International report significant drops in travelers heading to the States, especially in early 2025. Border towns like Sault Ste. Marie and Niagara Falls are facing major tourism revenue losses. Niagara Falls, one of North America's most iconic tourist destinations, saw visitor numbers from Canada plummet. Hotel, restaurant, and tourism revenues in the city are down 25% year-over-year. In Sault Ste. Marie, foot traffic at border crossings has dropped dramatically. Duty-free shops and local businesses are scaling down operations and laying off staff. The U.S. Travel Association reports that regional revenue in these areas has dropped nearly 30%. For many of these towns, the downturn isn't temporary, it's existential. Amazon's decision to shut down 7 fulfillment centers in Quebec, cutting 1,700 full-time employees and 250 seasonal jobs, wasn't just an internal logistics move, it was a clear signal of supply chain shock. These warehouses once served as strategic hubs for Eastern Canada and even parts of northern U.S. markets. Without them, Amazon was forced to restructure its delivery network, relying more heavily on U.S.-based centers or third-party providers, leading to delivery delays of 30–50% in affected regions. The fallout was swift. Order cancellations in Quebec surged to 20% in just 6 months. But more damaging than revenue loss was the erosion of something Amazon holds sacred: customer loyalty. Many Canadians pivoted to alternatives like Loblaws, Hudson's Bay, or Shopify-based sellers, platforms that weren't impacted by tariffs and could maintain pricing and delivery speed. For Amazon, it was a wake-up call. Trade wars don't just hurt profit margins. They can unravel digital ecosystems once thought untouchable in North America. In the EV industry, no one took a harder hit than Tesla. By the end of 2025, Tesla's Canadian sales had plunged 30%. It wasn't just about higher prices, it was about a shift in public sentiment. Canadian consumers, once proud buyers of American tech, now felt like they were paying for a product being punished by their own government, excluded from incentives, politically disadvantaged, and economically unjustified. They began switching to alternatives: Lucid, Rivian, and especially European brands that benefit from Canada's trade agreements with the EU, like CETA. What should have been a growth market became a dead zone on Tesla's trade map. To make matters worse, Canada formally removed Tesla from its EV rebate program, a political counterstrike that deepened the wound. Once again, we see how tariffs can derail an entire industry when consumer choice is driven less by innovation and more by geopolitics. No sector was spared when cross-border logistics broke down. Component costs surged 10–15% and lead times for delivery stretched by 2–4 weeks across the U.S.-Canada corridor. In the auto industry, Ford and General Motors had to cut shifts at factories in Michigan and Ohio. Why? They couldn't get critical parts from Ontario, especially electronics and mid-stage battery packs for EVs. With production stalled, Korean and European imports continued flowing in through alternate trade routes, eroding Detroit's competitive edge right on its home turf. Shortages rippled far beyond heavy industry. Walmart and Target hiked prices by 10–20% on essentials like milk, diapers, and eggs. Transport disruptions drove up logistics costs. Profit margins fell from 8% to barely 3–4%, forcing retailers to slash promotions and scale back product variety. McDonald's, heavily reliant on Canadian beef and potatoes, had to trim menu items and reduce portion sizes at many outlets across northern U.S. states. This wasn't just a matter of cost. It was the breakdown of a cross-border production-consumption ecosystem that had taken 3 decades to build under NAFTA and USMCA. Once that supply chain snaps, entire sectors stop responding to market logic and start reacting to policy chaos. In this new reality, businesses don't compete on price or innovation. They scramble to survive policy whiplash, and that's a dangerous place for any economy to be. Canadian families are feeling the pressure. American goods now come with a premium. Tesla vehicles. A Tesla Model 3 in Canada now costs an extra $5,000 to $8,000 CAD due to tariffs. Many would-be buyers are putting their plans on hold. Consumer goods. American-made items like coffee machines are now $50 to $100 CAD more expensive. Food staples like cheese and milk have gone up by 50 cents to $1 CAD per unit. For a typical household, this adds up to an extra $500, 700 CAD annually, just to absorb the added costs of U.S. imports. As a result, many consumers are now turning to local products or imports from places like Mexico and Europe instead. The boycott isn't staying in Canada, it's spreading to Europe. In the UK, France, Germany, and Italy, more than 30% of consumers now report avoiding U.S. brands, especially in response to how American tariffs have disrupted global trade. Mobile apps like BrandSnap and Detrumpify Yourself are gaining traction, helping European shoppers identify and sidestep U.S. origin products. One recent survey found that 22% of European consumers had used these apps to avoid American goods. This marks a major global trend. Political values and ethics are now baked into purchasing decisions. Price and quality still matter, but so does national policy. The 2025 Canadian boycott of American products and services is more than just a consumer protest. It's a political statement with real economic consequences. It reflects a broader shift in consumer consciousness and political awareness. If this movement continues, it won't just reshape U.S.-Canada trade. It could permanently alter how global supply chains, branding, and cross-border economics function. The trade war is no longer a headline. It's becoming a new normal.